trades is Ava Addo, COO and Chief Investment Strategist at ERShares. First up, Ava, Intel, China telling telecom carriers to phase out foreign chips. That is a blow to names like Intel, among others. The stock is down as a result, more than 5% today. What's your trade here?
It's a strong sell. Today we got the news. China, as you said, is phasing out foreign chips. 26% of Intel sales are to China. And then that's the top market. So if that goes away, then we'll see a big decrease on the revenues. That comes on top of very weak fundamentals. Their EBIT margin is 0.1%. That's almost zero compared to 21% for the industry average. The revenue growth is negative 14%, and their EBIT growth is also negative 38%. And then comes also side by side with the relatively high valuation of a PE of 94 compared to 26 for the average of the sector. It's a strong sell.
So where are you in Intel? There's China, there's foundry, there's competition.
Yes, completely agree, because I think the biggest thing about Intel also is operating leverage, because they own foundries. And because you have that large CapEx, you have to spread and allocate that cost across it. And if your revenues are coming down already, not just with China, and you're already one step behind producing chips, I think it's going to be at least a couple of years. There's plenty of other places to put your money in, especially in the semiconductor.
All right, Ava, let's move on. Agreement there. Let's move on to Arista Networks, slumping today after a double downgrade to sell from buy over at Rosenblatt. The firm says Arista's growth in AI-driven data center network switches could be thwarted by NVIDIA. Your trade on Arista.
I'll disagree with that. I have it as a buy. In fact, we own Arista Networks, and we also own NVIDIA. We've been in NVIDIA since it was a $5 stock. We still believe in both of these companies, that they have a great future. Arista Networks was actually upgraded yesterday by JP Morgan. Today, as you said, double downgrade. And their thesis is that NVIDIA will steal away their Ethernet business. We disagree with that. When a company is under pressure, it does not act like Arista Networks. Arista has a revenue growth of 34% when the industry average is only 6%, and it has an EBIT margin of 4 to 5 times its peers, and most importantly, a net income margin which is 35% compared to 2% for the industry. When a company acts like this, it's definitely not under pressure. It's a buy.
So if you were Taylor Swift, you would shake it off, this 8% decline today.
Exactly. I would actually buy. I think it's a very good entry point, and I wish I was Taylor Swift.
We can all dream. You can all dream.
Tyler, good preference. Finally, Ava, we asked you to pick a stock reporting earnings in the next couple of weeks. You chose Chevron. Why do you like this one?
And I like Chevron for the short term. I wouldn't have it as a long-term buy, but just because of the escalation in the Middle East and Iran now threatening for further escalation, I think Chevron is a good defensive position, and I like it when it comes to oil companies. They have very large position in oil fields, and they're geographically well positioned in Kazakhstan, which can target that region over there. Their net income margin is the top of the category. It's 11% compared to 7% for its peers. Its gross margin is 39 compared to 28. And even though it's a bureaucratic company, so I don't believe in it for the long term, it's a great defensive position for now. It's a buy.
So you were saying you like commodities, energy. What about Chevron?
I do. I like Chevron short term, and I like it long term. The longer oil stays at these levels, the better off it is for these integrated oil companies, because they get to sell the oil down the road at higher costs. And their production costs keep on going lower and lower. So when oil's at $80 to $90, they're minting money, and the longer it stays, the better they do, the more efficient they get. You've got a great balance sheet, a dividend that's 3% growing every year. It's one of those dividend aristocrats. I think, again, as a diversified portfolio, you want companies like a Chevron and an Exxon in there.
Ava, to you, what explains this market funk we've been in for the past couple of weeks?
Well, we have actually started making changes in our strategy. Now with CPI came 0.3, then 0.4%. Inflation is now running above the 2% target rate. So that's a concern to us. We've been moving to more profitable companies. We want to see companies that widen their margins. We want to see companies with great cash flow. So we think until we see the rate cuts, which is going to be pushed way further into the end of the year, we'll have a more conservative position. in growth, but way more conservative than we had in the first quarter.
Ava, we were discussing during the break the sell-off that we're seeing in JP Morgan shares, even after a decent quarterly report. Do you think this is a warning for the rest of earnings season that the bar is going to be set fairly high?
So I think we have good news and bad news. I'm actually optimistic when it comes to the earnings season. I think we'll have good earnings. Companies have been performing well. Companies have been proactive in maintaining their margins, widening their margins in some cases, cutting their costs. So I think I'm optimistic when it comes to earnings. I'm actually a little pessimistic when it comes to inflation. I think inflation, especially housing, is remaining sticky. Food away from home is rising. Energy costs are rising. So that's a concern. But I think it will be a healthy boost. It's to see some earnings coming up. And I think it's a stock picker's market. So you have to be very careful which companies you select.
Right. We'll see. It could change the focus from interest rates perhaps to earnings. Ava Ados, thanks for being with us.